A fuel cell is a device that combines pure hydrogen with oxygen. This chemical reaction creates energy. The only exhaust from the process is water. Fuel cells can be useful in very specific circumstances. For example, in the 1960s and 70s, NASA put fuel cells into its space shuttles. You can't have a diesel generator on board because that would consume oxygen. Batteries would be too heavy. So a hydrogen fuel cell is the only way to generate a sufficient amount of electricity to power the shuttle's electronics while it's in space. Hydrogen is very expensive to produce, store, and transport. Due to the prohibitive cost, fuel cells are not widely used for any applications, at least not on any significant scale. In the 1990s, a utility company called DTE Energy started experimenting with hydrogen fuel cells. While fuel cells were not economically viable at the time, maybe they could become viable at some point in the future. So DTE started building its own fuel cells. In 1997, they spun off their fuel cell division as an independent company called Plug Power. Plug Power IPO'd on the Nasdaq in 1999. Plug Power has now been operating for almost 30 years. They've tried to monetize their fuel cells in many different ways. Every single thing they've tried has been a failure. The company has incurred operating losses since inception and has cumulatively lost $7 billion in its lifetime. The company's share price has declined 98% since its IPO. Despite having a track record of losing money for the past 30 years, Plug Power always claims to be on the verge of a big breakthrough. Somehow, they always seem to be able to convince investors to give them more money to fund their losses. In this video, we'll analyze the curious case of Plug Power, a zombie company which has somehow managed to survive for 30 years while never making a profit. In places that have frequent power outages, it's relatively common for people to have backup generators attached to their homes. These generators are typically powered by diesel or propane. Plug Power's original plan was to sell a hydrogen-powered generator for residential use. A homeowner can purchase a Plug Power fuel cell system to be installed in their home. The fuel cell system would be powered by natural gas or propane. The system converts the natural gas into hydrogen, which the fuel cell then uses to generate electricity. Plug Power created a joint venture with General Electric. Under the joint venture, Plug Power would manufacture the fuel cells. GE would sell, install, and service them. The fuel cells would be co-branded as both Plug Power and GE. At the time, GE owned an appliances business where they sold refrigerators, washing machines, and other large household appliances. GE already had capabilities to install these appliances into customers' homes, so it should be relatively straightforward for them to start selling Plug Power's fuel cell systems as well. When Plug Power first IPO'd, its share price was $28. Initially, there was a lot of hype around the company. Plug Power made various claims that its fuel cell generators would be very efficient and may even be cheaper than just buying electricity from the grid. There was also a lot of optimism around the partnership with General Electric. By March of 2000, the share price had increased to $150, which gave the company a market capitalization of $39 billion. However, this lofty valuation would be short-lived. When Plug Power IPO'd, they originally said their fuel cell generators were almost ready, and they would start selling them very soon. But as time went on, the sale of these generators kept getting delayed. Investors started to lose confidence in the company, and the share price declined. In late 2000, Plug Power faced a class action lawsuit from shareholders who had lost money in the stock. The lawsuit alleged that Plug Power's fuel cell generator did not meet the technical specifications required by GE. Remember that these fuel cell generators were going to be co-branded with GE's logo on them. GE was putting its reputation on the line. They wanted to make sure these fuel cells were fit for purpose before they would start selling them. The lawsuit alleged that these quality issues were the cause of the delays. Plug Power failed to disclose this to the public. Plug Power vigorously denied any wrongdoing, but there was no denying the fact that the commercial release of the generators kept getting delayed. In 2003, Plug Power effectively confirmed the allegations from the shareholder lawsuit. In their Form 10-K filing, they disclosed that their initial fuel cell generator did not meet the specifications required by GE. Economic and technical difficulties may prevent us from completing development of products meeting these specifications and delivering them on schedule to GE. Our distribution agreement with GE was amended on 3 occasions. Basically, their fuel cell generator was not fit for purpose. We don't know exactly what GE's requirements were. They could have been related to efficiency or reliability. Regardless, the quality of the fuel cells was so bad that GE did not feel comfortable selling them. Plug Power was trying to improve the fuel cell, but this takes a long time. Eventually, General Electric gave up on Plug Power and the joint venture effectively died. The joint venture never sold a single fuel cell generator. Even without selling any generators, Plug Power was able to generate a few $1,000,000 per year of revenue. This came from R&D contracts they received from the Department of Energy and other government agencies. The revenue they generated from these research contracts was not nearly enough to cover their costs, so Plug Power incurred tens of millions of dollars of operating losses per year. After the GE joint venture died, it became clear that Plug Power's original plan of selling residential generators was not going to work. They needed to pivot to a new idea. So they made two acquisitions, a company called General Hydrogen and another company called Celix. These two companies specialize in making smaller fuel cells, which can be put on vehicles. Following these two acquisitions, Plug Power started making hydrogen-powered forklifts. Most large forklifts that operate outside are powered by gasoline or diesel fuel. You generally can't use these forklifts in non-ventilated indoor buildings due to health and safety concerns. Indoor warehouses tend to use smaller battery-powered forklifts. The disadvantage of battery-powered forklifts is that it takes a long time to recharge the batteries. A hydrogen-powered forklift does not create any harmful emissions. Its only emission is water. This means you can use it inside a non-ventilated warehouse. Refilling the hydrogen fuel tank is much faster than recharging a battery. This could be very valuable for high-throughput warehouses where downtime needs to be minimized. But there are a few major drawbacks to hydrogen forklifts as well. Hydrogen is very expensive to produce. To transport it, you need to cool it down to extremely low temperatures so it turns into a liquid. You then put it on a specialized refrigerated truck. The customer must also have hydrogen storage tanks at their facilities where the forklifts can refuel. These are very expensive to build and maintain. Pure hydrogen is extremely flammable and must be handled with care. This further increased the cost. Plug Power tried to sell their hydrogen forklifts to customers including Walmart for use in their distribution warehouses. At first, almost nobody was interested. Nobody had hydrogen fuel tanks set up in their warehouses. If you don't have hydrogen infrastructure in your warehouse, you can't use hydrogen-powered forklifts. In a recent interview, Plug Power CEO Andrew Marsh appeared on a podcast where he explained this problem and how they solved it. Let's have a listen.
Around 2011, Walmart came to me and had a coming to Jesus meeting with me, where Walmart said to me, "We're not going to buy anything unless you take over service, unless you take over delivering fuel, unless you take over fueling stations." So it was not really, quite honestly, a Plug decision. It was a Plug survival decision to start offering this full turnkey solution.
For Walmart or any other potential customer, they would only be willing to purchase Plug Power forklifts if Plug Power could also provide them with fueling stations to put in their warehouses and deliver fuel to those stations. So that's exactly what Plug Power did. Plug Power manufactured the forklifts and refueling stations, but they did not manufacture their own hydrogen. They purchased hydrogen from third-party producers and resold it to their forklift customers. By offering this turnkey solution, Plug Power was finally able to generate meaningful revenue. In 2019, they generated $230 million of revenue. But as their revenue increased, so too did their operating losses. The company burned tens of millions of dollars per year. The cost of operating a hydrogen forklift is significantly higher than a battery electric forklift. While there are some benefits in terms of not needing to wait for the battery to charge, this does not justify the higher cost. Therefore, the only way that Plug Power could convince any customers to buy their forklifts was to offer to sell them hydrogen fuel at below cost. Plug Power would buy hydrogen on the spot market and resell it to their forklift customers at a lower price. At least a lower price once you include transportation costs. While this was beneficial for the customers, it resulted in massive losses for Plug Power. In 2014, Plug Power's stock price was about $8 per share. As the company subsidized its customers, they quickly burned through their cash. By 2019, Plug Power's stock price fell to as low as $1. It looked like the company was headed towards bankruptcy. Then the pandemic happened. Plug Power stock skyrocketed, reaching a high of more than $70 in 2021. The government's reaction to the pandemic created the perfect storm for speculative bubbles to form in the stock market. The Fed cut interest rates to zero, causing investors to sell bonds in favor of more speculative investments. The personal savings rate surged. People were stuck at home, unable to spend money at restaurants, movies, or other in-person activities. People who lost their jobs got enhanced unemployment insurance, which in many cases paid them more than their previous salaries. With nothing else to spend their money on, millions of people turned to the stock market for the first time. These novice investors were attracted to high-growth technology companies, or at least companies which they perceived to be high-growth tech companies, such as electric vehicles and hydrogen startups. Plug Power was a big beneficiary of this speculative mania. They attracted attention from many influencers and commentators on social media. The surge in Plug Power's stock price created some peculiarities in the company's reported financial results. In 2019, the company reported $230 million of revenue. In 2020, they reported revenue of negative $93 million. So what happened? How is it even possible for a company to have negative revenue? At the time, Walmart and Amazon were Plug Power's two biggest customers by far. They both purchase hydrogen-powered forklifts to use at their distribution warehouses. As we explained earlier, hydrogen is not an economically viable fuel source because it is so much more expensive than electricity. To convince Walmart and Amazon to become customers, Plug Power offered to sell them hydrogen fuel at below cost. But that's not the only inducement they gave. Plug Power also gave Walmart and Amazon tens of millions of warrants. Warrants are securities that can be converted into shares of common stock at a specified exercise price, similar to a call option. Plug Power gave these warrants to Walmart and Amazon in 2017. At the time, Plug Power's stock price was very low. The warrants had exercise prices ranging from $1.19 per share to $2.12 per share. By 2020, Walmart and Amazon still owned tens of millions of warrants which they had not yet exercised. Walmart and Amazon were able to exercise their warrants and pay just $1 or $2 per share when the trading price of the stock was upwards of $70. The warrants are recognized as a liability on Plug Power's balance sheet. As Plug Power's share price increased, the value of this liability increased in tandem. The warrants were given to Walmart and Amazon in exchange for purchasing Plug Power forklifts. From an accounting perspective, the value of these warrants are treated as a discount to the purchase price. When Plug Power's stock price surged in 2020, the value of these warrants skyrocketed to hundreds of millions of dollars. That was greater than the purchase price of the forklifts. When you give a discount that is greater than the sale price of the product, your revenue is negative. Plug Power has incurred operating losses since inception. They fund their losses by issuing new shares, which is dilutive to existing shareholders. When Plug Power IPO'd in 1999, they had 2.6 million shares outstanding, adjusted for subsequent reverse stock splits. As of June 2025, they had 1.16 billion shares outstanding, an increase of 443-fold. If you owned a 10% stake in Plug Power at its IPO, that stake would have been diluted down to 0.02% today. Throughout the 2010s, Plug Power's stock price was very low. Because their share price was so low, their ability to raise capital by issuing new shares was limited. After the share price surged in 2020, it became much easier for them to raise money. At the end of 2019, the company had $140 million of cash on its balance sheet. Thanks to massive share sales at the top of the market, they were able to grow their cash balance to almost $4 billion by the end of 2021. Flush with cash, Plug Power was able to ramp up its capital expenditures to grow the business. Historically, Plug Power purchased hydrogen fuel from third-party suppliers and resold it to their customers at below cost. In 2021, Plug Power announced plans to become vertically integrated. They would build their own hydrogen production facilities and use renewable energy to produce so-called green hydrogen. In August of 2022, Plug Power CEO Andrew Marsh gave an interview on CNBC, where he explained this new strategy.
Yeah. So, Sarah, the two big items on the cost side is this company's become vertically integrated. We're building out green hydrogen plants, which takes our negative margin in purchasing hydrogen from others to over 30% gross margins. So it is, that in itself helps drive this company to profitability. And on our service line, we're seeing dramatic improvements. We'll be gross margin break even when serviced by year end. So the numbers, add up that we will achieve profitability in 2024, as our CFO said yesterday on the call. And in 2025, we'll be at 17% OI.
Andrew Marsh claimed that their new green hydrogen will be much cheaper to produce, and they'll achieve gross margins of positive 30%. For their service segment, they expect to be gross margin break-even by the end of 2022. Plug Power will achieve profitability in 2024, and they'll make an operating margin of 17% in 2025. That all sounds pretty good. Unfortunately for Plug Power's shareholders, nothing Andrew Marsh said turned out to be true. In both the services and fuel segments, Plug Power continued to incur massive gross losses. On a consolidated basis, the company continues to incur massive gross and operating losses. Andrew Marsh said Plug Power will be profitable in 2024. In reality, they incurred an operating loss of more than $1 billion. He said they would have an operating profit margin of 17% in 2025. In the first half of 2025, they reported an operating margin of negative 106%. The idea that Plug Power could achieve profitability by producing its own green hydrogen was pure fantasy. To understand how dumb this idea was, we need to understand the difference between gray and green hydrogen. Hydrogen is generally created from water. Water is made up of hydrogen and oxygen atoms. You need to separate the hydrogen atoms from the oxygen atoms. Generally speaking, there are two ways to do this. One way is to combine water with either coal or methane. Methane is also referred to as natural gas. Coal and methane both contain carbon atoms. The carbon atoms combine with the oxygen atoms to create carbon dioxide. You can think of it as the carbon sucking the oxygen out of the water, leaving behind pure hydrogen. Importantly, this process does not require any electricity. You just combine methane with water under the right conditions and the process happens on its own. The downside is that this process creates carbon dioxide emissions, which is a greenhouse gas. This is called gray hydrogen. The other method is the electrolyzer method. You run electricity through water. This causes the hydrogen and oxygen atoms to separate. This process does not directly create any carbon dioxide emissions. If you use green energy to generate the electricity, no carbon dioxide is emitted whatsoever. This is called green hydrogen. Gray hydrogen and green hydrogen are identical. They are both pure hydrogen. The only difference is how they were created. Today, the vast majority of hydrogen produced globally is gray. This is because gray hydrogen is significantly cheaper to produce. The cost of the coal or natural gas you need to create gray hydrogen is much cheaper than the electricity you need to create green hydrogen. According to a recent analysis by Bloomberg, gray hydrogen costs approximately $2 per kilogram to produce. Green hydrogen costs about $5 per kilogram. Green hydrogen is more than double the price of gray hydrogen. In the past, Plug Power purchased gray hydrogen from third-party suppliers. Even this was too expensive to be viable as a forklift fuel. That's why they had to subsidize their customers by selling it below cost. They transitioned to making their own green hydrogen, which is always more expensive than gray hydrogen. Andrew Marsh goes on television and absurdly claims that their green hydrogen is going to get them to profitability. Obviously, this did not happen, and the company continues to incur massive gross losses. As the company disastrously failed to meet its profitability guidance, investors again lost confidence. Plug Power's stock price has fallen by 97% from its recent highs, and now sits at just $2 per share. But the company has not given up. Andrew Marsh continues to talk up his delusional plans for how he's going to bring the company to profitability. The latest narrative they're trying to sell is that their fuel cells will provide electricity to AI data centers. They plan to make stationary fuel cells, which can provide backup power to data centers during power outages. Today, data centers often have backup diesel generators for this purpose. Some data center operators, including Microsoft, have discussed their intention to eventually switch these to fuel cell generators at some point in the future, so as to reduce carbon emissions. We've now come full circle. In the 1990s, Plug Power's first proposed product was a stationary fuel cell to be used as a residential backup generator. This product was rejected by General Electric due to quality issues. Is it possible that Plug Power could make a successful business selling fuel cells to data centers? Anything is possible in theory, but it's worth remembering that this company has failed at pretty much everything for the past 30 years. Why should we expect any different results in the future? Alright guys, that wraps it up for this video. What do you think about Plug Power? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.